Where are my Noti gang members? Noti, 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 Noti. Everybody tweet. Let people know on our various accounts that we're live. Send them the YouTube link. We got a lot of other accounts. Tell them in chat we're live. Maybe tell them in the Slacks. Tell them in the Discords we're live. We should have a best practice, Justin. When I go live, do we have a checklist of what we do?
We do not. We just
Great. So let's do a going live checklist. For example, we could be tweeting from the launch account, just at Jason's live, and put the YouTube video in. We could tell the Slack and the Discord for This Week in Startups that we're live, et cetera, et cetera, et cetera. And yeah, great. All right, Noti Gang, I see you here. I see you. I see Nima. I see Patrick. I see Frank. I see Christopher. I see Sam, Chester, Alex, Connor, Johanna. Great name. Jeremy, Joe, Sakura, Richard Wu, Sam, Jay, Serge is part of the Noti Gang, Quilly, Head Jobs, interesting. Mayor is here again. Raymond is here. So many Noti Gang members. I'm going to tape the news for tomorrow's show tonight. So thank you for coming. And you know what to do. Give a thumbs up for your boy, J-Cal, and for the hardest working producers in the business on the YouTube, youtube.com/thisweekin. You go to that website, you give a thumbs up, you subscribe, maybe post a comment, say hello. I want you to tell me what city you're in and how long you've been listening to This Week in Startup. So in the YouTube at youtube.com/thisweekin, tell us what city you're in and how many years have you been listening to This Week in Startups? I'm really curious with my Noti Gang. Now, if you're on Facebook, what are you doing there? On Twitter, you can hit reply and answer the same question. I'll see it here because we use a beautiful piece of software called Restream, and they are brilliant at Restream. And we're able to put all the different comments from Twitter, YouTube, Twitch, Facebook, LinkedIn into one feed. So if you're on LinkedIn and you're seeing this, please comment on LinkedIn and like and share the post. And I see 7 people have already liked this video. Thank you for doing that. One person voted me down. That's heartbreaking. But there's London, Vancouver, Canada. Been watching for a year. Amsterdam's been watching for a year. Minneapolis, 2 years. Where you been? You are so lazy, Jason. You should make more videos. Thanks for trolling me. So yeah, great. Tell me where you are. San Jose, 8 years. Great. Show's been around for 11. So if you say 12, I'm going to wonder about you. So go ahead and tell us in the chat or wherever you are, reply back. Where are you based and how many years you've watched This Week in Startups? So we're going to tape the show that goes out, after midnight or first thing in the morning, and a lot of news. And we got a great interview at the back. So you're going to hear me read the news. If you have comments on what I'm talking about news, you can just have at it. Have a conversation. There's our first, I think, LinkedIn user. I see our first LinkedIn logo. Javon, you are Noti Gang for LinkedIn. I don't know if LinkedIn has notifications. And Francis from Romania, I think you're the first on Facebook. Is there anybody on Facebook in Romania? Is anybody still using it? San Francisco, 0 years. Okay. New York City, like 10 years. Love to see it, Michael. Okay, let's get started with the news. Here we go. Do you got your QuickTime running, J-Cal? No, I don't. Let me get this.
Oh, I thought you said that you did before.
I didn't. I'm a little tired right now. I got vaccine shots yesterday. Not COVID. I got shingles and tetanus. I've been getting all my vaccines, and I don't know. That shingles, when they told me it would knock me out, I am knocked out today. Man, I feel low energy.
I didn't know that shingles was still a problem.
I just said, what are all the vaccines I can take? And they're like, here are all the vaccines. I was like, I'm just going reverse Kyrie on this. I don't want to catch anything. I'm going to reverse Kyrie it. All right, Nick's tape. Yes, I'm here, and the book club is next. So we're going to be live streaming the book club. If you go right after I do the news here, we're going to go right into book club. It's going to be awesome. Hopefully you guys can help carry me talking about the book. 3, 2. Okay, Sequoia Capital made a huge announcement today. They are redoing their fund structure, and they will have a new vehicle in a master vehicle called the Sequoia Fund. Okay, Sequoia announced a new fund structure today. It's called the Sequoia Fund, and this is going to be like their mega, main fund. And Roelof Botha, a good friend of mine, published a blog post on Sequoia's Medium page this morning. It's titled The Sequoia Fund. patient capital for building enduring companies. And that's always what they've been. I've had Ruloff on the board of Inside.com for over 10 years. He's got bigger fish to fry, but he still comes to every board meeting. What a guy. Really one of the greatest venture capitalists of all time. And he's like me, still young and in the game, or relatively young in the game. So let me give you a background of how a venture fund typically works and why people say, hey, maybe it's too short of a time period. LPs, rich people, endowments, nonprofits, and the like will give large amounts of money to a venture capitalist in a fund. They typically name the fund, launch fund 1, 2, and 3. Someday, who knows, maybe I'll launch fund 4. I'm not allowed to talk about that because of SEC regulations. But these funds tend to be sequential. So there's a Sequoia 10, 11, 12, 13. And then you might do vertical specific funds. You might do one just for early stage, one for just late stage, one for just crypto. And all of those funds have a 10-year horizon. That's the standard. But what we've seen is some companies stay private longer than 10 years. Airbnb and Uber, the two notable examples. As well, the value of those shares when they do go public, they tend to do even better when they go public. And so, according to PitchBook, Sequoia has over 60 funds since 1981. That seems directionally correct to me. China, India, growth, seed, the classic venture funds. But the problem is that when they distribute the shares to their LPs, so Uber goes public, they distribute the shares. WhatsApp gets bought by Facebook, they distribute Facebook shares. And full disclosure, I'm in business with Sequoia. They're LPs in my fund, and I was the first Sequoia scout. But I haven't talked to them about this yet. So I thought I would just explain it to all of you folks as best I can. Imagine if when Instagram, YouTube, Google, Apple, and all of these great companies that Sequoia invested in, and they might own 10%, 20%, even upwards of 30%. Instead of sending those shares at the very low valuation of when the company first goes public versus waiting 10 years or just leaving it in the fund, and then those funds allocating money to the sub funds. So these sub funds will still exist. In other words, their seed fund or their sequentially numbered fund will still exist. Those folks will determine when they want to distribute the shares. So they say, okay, Square, which is a famous example, they went public at a very low valuation, and now they're a magnitude higher. In fact, Ruloff is still on the board of the company. And that was his example here. It's like, listen, Square has returned billions of dollars tens of billions of dollars post being public. We should keep it, not sell those shares. And Sequoia knows the company best, so those LPs don't have the experience working with these companies. They want Sequoia, or in my case with the launch fund, or in David Sachs's case with Kraft or Chamath Social Capital, or with Friedberg, the production board. Those LPs who give us money, they trust our judgment, and they are giving us carry. They're paying us a portion of the returns in order that we make the best decision possible on their behalf. And that's why it's a really, I take it very seriously, the job, because you have to make some serious decisions. When do you sell the shares? When do you distribute them, et cetera? And if you were to distribute your Amazon shares or Apple shares when they went public as opposed to holding them, my Lord, that could be a big difference. In fact, my crack research team talked a little bit about that. And we don't know if this is actually correct, but if Apple went public in 1980 at like a $1.8 billion valuation, we found that number online, and now it's at a 1.8, is that 1.8 billion you have there?
Yeah, Apple went public at $1.8 billion valuation.
At this $1.8 billion valuation, and now they're worth $2.5 trillion. That's over 1,000x, not percent, X. $1 equals over 1,000. It's actually 1377 according to our back of the envelope here. And this is all back of the envelope. If Sequoia owned a decent portion of it, because they put in $6 million for...
they sold their stake for $6 million.
In
Sequoia, 1979. That was their big mistake that they made.
Yeah. And according to our research, Sequoia sold their stake in Apple in 1979 for $6 million, 18 months after investing. If they had held that till today, it would be worth over $8 billion easily, maybe more. Who knows what stock splits and other devices occurred at that time. So what this will do is it's going to flip the model around where Sequoia can just manage the Sequoia fund while still doing venture capital. So all those public interests will be in there. And here's some quotes from his blog post. Moving forward, our LPs will invest into the Sequoia fund, an open-ended liquid portfolio made up of public positions in a selection of our enduring companies. In other words, we're going to keep the shares. So you invest in that fund. Then the Sequoia fund, quote, will in turn allocate capital to a series of closed-end sub-funds for venture investments at every stage from inception to IPO. Great. So if you're an LP, instead of going into specific funds, you go into this big fund, and then that fund then hands the money off to each of these sub-funds. Here we go. This is the important part. Proceeds from these venture investments will flow back into the Sequoia fund in a continuous feedback loop. Investments will no longer have expiration dates. Our sole focus will be to grow value for our companies and limited partners over the long run. This new structure removes all artificial time horizons on how long we can partner with companies. It enables us to participate on their boards and help them realize their potential over the course of decades. Because if you distribute the shares, now you own, less than 20% or less than 10%. Do you really get to keep a board seat? No. That's why VCs roll off of these boards typically, unless the founder wants to keep them. So this is just an incredibly disruptive thing to do for obvious reasons. It also, and quote from Roelof's post, it also lets us hold public shares long after the IPO and seek the best long-term returns for our limited partners. In other words, we will decide when to sell those, if at all. So they can make a decision if they have a bunch of shares. Do they want to sell them? Do they not want to sell them? Do they want to sell 10% of them, et cetera? So let's just do a thought exercise here. Imagine if they had held Apple, Google, and WhatsApp, which got bought by Facebook and then resulted in Facebook shares. This would probably be close to a $200 billion public fund. So we covered the Apple one, right? And what that could have been worth, $10 billion. Then you look at the Google investment. Well, Sequoia co-led Google's $25 million Series A. Sequoia had something like 22 million shares at $85 a share at Google's 2004 IPO. At that time, it was worth $1.9 billion approximately. Then Google, which IPO'd at a $23 billion valuation, we know is now worth almost $2 trillion. So it's $1.86 trillion at the taping of this. So that's 80x since the IPO. And my understanding is many of the partners at Sequoia never sold their Google shares. They just hold them. I mean, is there something better to hold than Google? Is there something better to hold than Apple? Not to the best of my knowledge. Like, why would you ever sell those shares? The WhatsApp investment, Sequoia reportedly owned, you don't really know all the exact details here, 20% of WhatsApp after doing the seed, Series A, and Series B rounds. That was another groundbreaking innovation from Sequoia, which was they just made that same firm that was growing like a weed, WhatsApp. They just offered them each round of funding, and you don't have to go out and even tell anybody what you're doing, share your deck. We'll just give you the money. Some people would consider that bad hygiene. And it really is based on the outcome. So if you saw Andreessen Horowitz did 3 investments in like 18 months in Clubhouse, one at 100 million, one at like $1 billion, and then one at 4 billion, that would be bad hygiene because the result was bad. If Clubhouse turns out to be worth 100 billion, they're going to look like geniuses. That's basically how the industry works. If you're right, it was the right bet. If you're wrong, it was the wrong bet. You should not have gone all in. So WhatsApp sold to Facebook in 2014 for 16 billion, about 4 billion in cash, 12 billion in stock. So if you look at that, Sequoia probably turned 60 million into 3 billion in 4 years. Well, at the time of the acquisition, Facebook was at $55. It's gone up almost 6x since then. So the investment would be worth close to 20 billion for Sequoia. So this is just a brilliant way to have a bigger impact in the space. They'll have more influence. This wasn't mentioned, but if the Sequoia fund now owns, like Fidelity or Goldman or other funds, owns a significant portion of a public company, hey, you have direct access to the founders. You have direct access to the management team. Not that they don't already have that, they're Sequoia, but you do have more influence because you've been more helpful. So now they did talk about, would this be publicly tradable? It's not going to be publicly tradable. This will all be private. So it will scale forever. And there'll be, my understanding is there's going to be a redemption period every year. So every year, if you're in the fund and you're patient capital, which is think, the Ford Foundation or Harvard or MIT, one of those great endowments or nonprofits, that's, I think, 90% of the money in Sequoia's funds. I'm taking a guess here. Then you are not trying to day trade. You trust Sequoia. Brilliant. Every year you make a decision if you want to get some of that money out if you need it. And if not, well, you got the best in the business watching your investment, and they're going to know what decisions to make. And if you don't like their decisions, well, of course it's your money and your returns, you can sell out. Brilliant idea. I do think a number of people will copy Sequoia. This seems like it will also be better for taxes because when you distribute your shares, you don't have a tax event. So LPs get the shares, but then those LPs then sometimes decide to sell their shares, pay taxes, and then put that money to work in another venture firm. Here, they can just leave them in there, let them grow. It's not like these endowments are looking to liquidate. It's not like, I think, if Harvard's at 50 billion now, it's not like they need $20 billion tomorrow to buy a small, series of islands in the Pacific. They're not making big purchases. They're just using the interest on those endowments to run those universities, or Ford Foundation to run their, really virtuous programs in the world. So congratulations to Sequoia, great leadership. And I think everybody who's got multiple funds will work towards this, and it will quickly become the standard. Okay. Anybody have questions in there? I
Can
haven't
you just
had
do
Michael
one
Moritz
bullet
on
point?
Twist. I should have him on. I will invite him.
You missed one bullet point.
Which one?
I'm hovering over it. Sequoia's investment in Google will be worth this much.
3, 2. Now, Sequoia's investment in Google today would be worth around $150 billion with a B. So, this fund would be an extraordinary fund just based on those 3 companies. Okay.
Good.
Great. Okay, let's do the Robinhood earnings. Okay, here we go. 3, 2. Okay. Can't make me laugh. 3, 2. Okay, Robinhood just reported their Q3 earnings, and they disclosed a 35% Robinhood reported a Q3 earning. Robinhood reported their Q3 earnings and disclosed a 35% decrease in top line revenue from Q2. Robinhood stock is currently down about 9% in after hours trading. Q3 revenue was $365 million. That's up 35% year over year, which puts you in the high growth category. But it's down 35% from the monster quarter they had last quarter, which was $565 million. And so when you look at this chart here, we have a little chart if you're watching the YouTube channel or the live stream. You can see this incredible run up during the pandemic. The company grew like wildfire. People had stimmy checks. People were obsessed with crypto. You kind of knew there was going to be a spike, and now things have come back down to earth. People are going back to work. Maybe they're not day trading as much. So a little bit of a retreat. But if you compare year over year, which is what you really want to compare as an investor, and the next quarter will be critical because you're going to want to look at year over year for the next quarter and year over year for this quarter. Are they still growing? And then you could take those 2 quarters, Q1 and Q2, and you could chalk those up to being just runaway quarters that might not be easily repeatable. So they had a net loss of $1.3 billion, and last year their Q3 was essentially break even. Some pretty heavy losses here. Obviously, they're investing in the business. Q3 average revenue per user, ARPU, $65 a user. That's great. But it's down from the $102 a user year over year because, again, people were maybe more actively day trading. So if we look at Q3s, the monthly active users retreated as well, 18.9 million. Now, this is up 76% year over year. So remember, we talked about yesterday, Facebook having a decline in users, but some growth in revenue. Here we have a 76% year over year growth in users. That's extraordinary. But it's down 12% from Q2. Because you remember, everybody opened up accounts when they saw the GameStop and Stonks and AMC. All this stuff was national news. Everybody was talking about Robinhood, and they also had their IPO. So that drives a lot of interest in the company. So if you compare that to other, contemporaries, the old ones like Charles Schwab, they have 32.7 million, and Fidelity has 26 million retail accounts. So this upstart is now right behind Charles Schwab and Fidelity. And you do expect that some people will, in a really hyper frothy market, go check out apps. We've seen it before where people get excited about an app. It's in the press. They try it, but they're not like the ideal customer profiles. The assets under custody is 95 billion. That's up over 115% year over year. Down slightly from Q2, which was 102 billion. This is a very significant statistic as well. This means how much do all the accounts have in them combined? And so super revealing that this is a lot of money to be the custodian of. Vlad noted that this quarter was focused on developing new features. And this is critical because when a company grows this fast, let's face it, the wheels can come off, things can break, have customer support problems, which we saw Coinbase, had national news, CNBC talking about people having their accounts hacked and there's no phone number. And obviously Coinbase did make some changes and got some phone numbers going for account resets. So these companies really grew faster than anybody ever anticipated. Getting to 20 million users, my God, 20 million accounts is crazy, unprecedented. So a little retreat and a little bit of like maybe cleaning up shop and building some infrastructure here is a really good move for startups that are growing too fast. We saw Uber do it, Airbnb. Many people have gone through this where things were moving really fast. And you said, you know what? We need to shore things up and make sure this is built to last. And I believe Robinhood, Airbnb, Uber, these are all built to last companies. It feels like that to me. So one of the big efforts they're going to have is this crypto wallet. And so Robinhood announced that in late September. Vlad announced that the waitlist was already over 1 million users. And this is critically important. When you have a huge base of users, you can launch products that are adjacent to yours. And that will then, you don't have to acquire a customer for that service. It just shows up in your app. So when I use Wealthfront, at some point they put margin loans in or 529s. I had Andy Radcliffe on here many times on the show. And he talked about that strategy. We just want to keep releasing new features. This is similar to Google releasing Chrome, Gmail, buying YouTube, Android. They have all these Google search users. Google Docs gets put in your interface. Even Google Plus got put in your interface and then removed because it was so terrible. It actually was a great product, but it should have had its own domain name. That's a story for another time. So Robinhood introduced crypto trading in 2018. And in Q3, crypto trading accounted for 51 million of transaction-based revenue, about 14% of total revenue. So Robinhood clearly wants to boost its crypto presence, and that's why they're making this crypto wallet. Robinhood offers no-fee crypto trading, which they can use to market against Coinbase, which is staggeringly expensive, I think, is what I hear from most people who trade crypto. 1.5% fee on all transactions using a bank account. So I don't know if that's staggering, but I think for crypto folks, they feel it's high. Coinbase has 68 million verified accounts. So that's verified. That's not necessarily monthly. So you could have many verified accounts and then maybe, people are hodling and not using them every month. So they're reporting on two different numbers there, but clearly Coinbase has done an extraordinary job. They're also, Vlad noted, they're going to do live 24/7 phone support. And that's going to be a big game changer. Doing 24 hours, 7 days a week is coming over the top and basically providing more than, a lot of other services do where you have to call during business hours. They announced in a press release that Robinhood would be offering retirement accounts in the future. This means they're going to go up against Betterment, Wealthfront, which we have a position in. And so you'll start to see all of these different financial services, kind of race towards a singularity, a banking account, a checking account, an ATM card, a Visa card. All of these things are going to be offered in all of these services. It's just so clear to me. It's just a matter of the prioritization and how good they are, how much they delight users. One really cool thing they did was they were using Say Technologies, which was acquired in August of 2021, and they took a handful of questions from retail investors, which typically only the banks ask questions during these calls. So they're really still on that mission to democratize. So if as a Robinhood shareholder, I believe this company will be worth 10x in 10 years. That's why I'm holding my shares. Great management team, loyal customer base, incredible product design. It's not an accident when somebody gets to 10 or 20 million accounts. It's not an accident when somebody builds a world-changing, beautiful app. So when I see that, whether it's Uber, Airbnb, Tesla, you don't bet against great product and founders still at the company, running those companies, making those great products. And so Robinhood, Airbnb, Uber, all have world-class products. Uber doesn't have the founder there anymore. So that would be a little mini red flag. So take that for what it's worth. But I think they got a pretty good CEO who's been doing a pretty good job of getting them focused on what matters. And I think their earnings will be in November. They're a little bit behind everybody else. This is the big week for earnings. Okay, let's go to our next story. Twitter has also reported their Q3 earnings and noted their revenue was less impacted by iOS privacy changes than they anticipated. That's interesting news. Twitter stock is up about 4% after hours, $63 a share. Q3 revenue, $1.28 billion. That's 37% year over year. We talked about this on the program. If you're above 20, 30%, you're in that high growth category. Ad revenue totaled $1.14 billion. That's up 41% year over year. And ad engagements, which is like when you click on an ad, you open it up, you reply, you retweet, you like, or you bookmark. Those were up 6% year over year. Cost per engagement increased 33% year over year. They really love that cost per engagement metric. I don't know if that's important. Everybody hits the like button. Who knows if that's actually important? But they report it, so we'll pass it on. The operating loss was $743 million. Operating margin of negative 58%. This includes a one-time litigation charge of $766 million. The original lawsuit was filed in 2016. It alleged Dorsey, among others, hid facts about the slowing user growth while selling their personal stock holdings, according to The Verge. So, I don't think the terms of that settlement are detailed. Usually those things are paid for, and then everybody moves on. So you can take out profitability for this year, for this quarter, and you can just strike it from the year because, listen, the company is worth a lot of money. And so it's an expensive speeding ticket, but a speeding ticket nonetheless. Q3 net loss, $537 million due to the fine that Twitter paid for the user counts to settle that. Last year, they had a profit of 30 million or so, 29 million to be exact. And so that's an interesting sort of rub here, is that Twitter feels like it's growing their product and doing interesting things, and the revenue is growing. But it does feel like there should be more going on here. I think there could be some acquisitions that occur that would be really great if they could buy some things that maybe grew it. But Twitter is a very unique product in the world. It's super influential amongst a certain cohort of people. They've never been able to get everybody on the platform. Everybody doesn't like it. You have to be kind of chatty and addicted to Twitter to really get into it. You have to be kind of an influencer, or you're really passionate about things. It's kind of different than the family-friendly Facebook stuff or the salacious, dancing meme stuff on TikTok. It kind of falls into like this intellectual influencer, business influencer, journalist vortex, which might be interesting to look at. The fact that they gave the blue check marks to all the journalists early and all the CEOs and all the athletes, I think that actually defined the service, that it was a service for influential people. And so when you don't have a blue check mark, you kind of feel like a second-class citizen. I know when I go back to my old account and I don't have the blue check mark, I think my tweets don't get taken as seriously. Just interesting, those early product decisions. The biggest story here, I think, is that the Apple iOS 14.5 app tracking transparency features, which launched in May, those are supposed to cause all these kind of headwinds, and they didn't. That is a good sign. Twitter announced new features in Q3. Communities. This allows users to interact with members of a group like Facebook. I haven't been invited to join one yet. Tipping. I have seen tipping like Cash App, and I see people starting to have that in their bios. Just a couple of people have it. I applied to get it. I didn't get it. Super follows, which means you can subscribe only to content. Again, I've only seen one or two people with it. I asked them to give it to us. I would like to test it. And there's a safety mode, which temporarily blocks accounts for a week that use harmful language or send repetitive replies, mentions. So it does feel like Twitter is, getting safer. They've done a good job with dealing with trending topics, even in the face of the chaos around COVID and the January 6th insurrection, or if you're far on the right party protest. Kind of feels like an insurrection when you talk to the police who were dragged out, but let's keep the show not political for now. And so great job to the Twitter team. The product velocity has been great. And of course, Twitter Spaces doing great. They didn't mention it in the call, I don't believe, but I do believe the velocity of products at Twitter is moving faster. I've been obsessed with Review, which is their email product, kind of a company that came, I think, before Substack to do paid newsletters. And what I found was, if you go to twitter.com/Jason or twitter.com/TWI startups or /launch, or, a bunch of our accounts, we have mailing lists, and I'm paying like $1,400 a month for a MailChimp. And then it's free on Review, and it's connected to our Twitter. So I took like 3 or 4 of our email accounts where I had my team do it. I don't do any work. And they moved them over. And now we're collecting 12, 50, whatever emails a week on those accounts. So we're getting email signups. And then our bill for MailChimp, I think, went from $1,400 down to $1,000. So I'm starting to think I don't even need MailChimp anymore because Review is giving it to us for free. It's kind of a big hack, isn't it? Now, there are some features MailChimp has around templates and around cross-referencing lists and making, new segments that, power users are not going to give up easily. And so they'll stick with MailChimp. In fact, we will stick with MailChimp for some of those reasons. But we've already started to deprecate our MailChimp account to just try to get that payment from, what is 18,000 a year now or something, and get it down to 10 maybe, because it's expensive. We use it a lot, but if we can save money, I'm going to do it. Right? It's the nature of business. Okay. Do we have a handoff for an intro?
Yeah,
Where's
we
the
have an intro at the top.
Okay, I'm going to do a handoff right now. 3, 2. Okay, next up on the pod, Bolt CEO Ryan Breslau talks to me about his one-click checkout software, and he made some news a couple weeks ago, and that's why I had him on the program, because he started implementing a 4-day work week. How does that sound? Might that interest you? Well, we get into it and we talk about all the mechanics and what it's done for the culture at Bolt. Great guest. But first, we're going to cover some news. Sequoia has an. Oh wait, that was my handoff.
Yeah, you did a switch up there. And it's Breslau, not Breslau.
Breslau. I'm going to start over. Okay, next up, my talk with Bolt CEO Ryan Breslau.
Breslau.
3, 2. Oh, 3, 2. Okay, next up, my conversation with Bolt CEO Ryan Breslau.
Got it. Nailed it.
3, 2. Okay, we've got an amazing show for you today, and I don't mean that like I did the other 1,000 times I said it. Today is actually the best show ever. I'm going to talk with Bolt CEO Ryan Breslau. He sells some one-click checkout software, but he made some news a couple of weeks ago when he announced that Bolt would implement a 4-day work week. Might that interest you? Sounds pretty interesting to me. When we talk about his unique ideas about culture, raising money for startups, and this 4-day work week and how it's going. Do they get Fridays off if it's a holiday week? Lots of questions. Do people get a 20% pay cut? I had a ton of questions. He had a ton of answers. But first, let's chop up the news. Sequoia announced a groundbreaking, innovative new fund structure. That's going to change Silicon Valley forever, and I'll break down how that is working. It's kind of technical, but kind of important, so you're going to want to hear that one. And then we'll talk about Robinhood and Twitter and their Q3 earnings and some of the products and trends that are impacting those earnings. Stick with us. It's going to be a great show. Okay, rate the intro. Rate the intro.
That was like a 7.
7? Should I do it again?
6.5, 7.
My energy's low.
No, I know you're tired.
Tired. Should I do it again? Should I try one more time?
You don't have to do it again. It's fine. I don't think anyone's going to tune out after that. I do have one ad read for you, though, before we go.
Okay. Where's the
Sorry.
You
didn't stop your recording, right?
I did not. I'll do the ad read live so everybody can hear me doing it. And people love. What's your favorite ad read for me? Do you remember the...
Yeah, I wasn't here for
MailChimp?
that. I think I was in middle school.
Now MailChimp's never going to... When I just told I was getting rid of MailChimp because the prices was too high. Now, or I was testing review versus it. I mean, oh my Lord. Now they'll never
whatever.
Come back
they just got they just got bought by Intuit, right?
I know. Intuit's now I lost 2 advertisers.
Drop the bag.
It's all right. I got a couple bags over here anyway. Go calm.
Embroker. Yeah, not your bag, my bag. Oh, okay. I don't care about your bag is fine. I'm worried about my bag.
Which bag? I just tripped over 3 of them on the way in here. 3, 2. If you don't have business insurance, you failed one of the first steps in being a great entrepreneur. Startups should look no further than Embroker in getting great insurance that will protect you and your team and your vision and your investors and your board members. Here's how Embroker works. Their technology saves you a ton of time and a ton of money. Prices are up to 20% lower, and they have better coverage than the incumbents because they use technology. You know the story. So you can go from sign up to a quote and to purchase in just 10 minutes. Trust me, I've worked with some of the other insurance brokers. It takes not 10 minutes. It takes 10 weeks. It takes 10 days. It is brutal. So when you work with Embroker, instead of those incumbents, you're not dealing with large, slow corporations. And the sign up takes just a couple of days, not these weeks or months that I've experienced in the past. And the process is transparent with no opaque pricing. It's like going to buy a Tesla. You don't haggle for the price. I looked at a Land Rover Defender. Guy wanted 15 over sticker. I don't want to buy stuff like that. I want to go to a website, click, 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 give me my car. I walked out. I was like, I'm not paying you over 15K on top of sticker. Get out of here. Well, that's the future here right now, isn't it? Just tell us what the price is. Be transparent. That's what Embroker does. So I'll explain 2 crucial types of insurance that you need to know about. Cyber insurance. This is obvious. It covers hacks. That happens all the time. You just don't hear about it. And you need to have that insurance in case you get lawsuits, you get sued, or worse. And D&O insurance. This helps you if directors, people on the board, or officers, and the C-suite, the top 10, 5, 10 people at a company, do something really dumb. And then you get sued. And you know what? You don't even have to do anything dumb. I've gotten sued in the past by people who were just, using ambulance chasing lawyers to just sue me for things that never occurred. I won every time, but I still had my insurance, so I could be confident. When those lawsuits came in, my blood pressure did not change. I just looked at it and I was like, put it in the pile. like no big deal. I'm insured. I'm fully insured. I don't have to worry about this. So here's your call to action. Here's your call to action to instantly buy custom built insurance for startups. I want you to go to embroker.com/twist. 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 And while you're there, you're going to get an extra 10% off if you use the offer code TWIST, TWIST. That stands for This Week in Startups. Okay, thanks, Embroker. Great job.
Great,
Good?
Great read.
Okay.
Yeah, that was a good
wow.
read.
All right, now what do I got?
You left it on the field.
I left it on the field, and now I got to
go talk to 400 strangers about a book. Have fun.
Thanks. I did this to myself. And you guys did it by bucking my schedule the way you guys book it. I'm taking away everybody's access to my schedule. That's it. I need help.
Except me.
I need a co-host. I need a co-host here. Can I get a co-host in here? What if I get sick? 5 days a week. We're sold out for 3, 4, 5 months in advance now. What if I get sick? What if I get COVID, God forbid? What if I get
No, we can do. You can podcast from a hospital bed.
I would
laptop,
do it. Totally
microphone. I know you would.
Totally
yeah,
I would.
Nice and easy.
I'll do it. My flu.
The biggest problem would be getting an Ethernet connection in the hospital, I think.
Yeah, exactly. I'll be on life support. They ventilate me. Take the vent
Use it as
out.
electricity. It'd be great. All right, this is getting dark. We should probably shut this down.
It's getting dark. All right, Noties. I'll see you all next time. Bye-bye. Love you, Noties.